So the most keenly awaited, event in April was the RBI monetary policy. Largely, it was in continuation of the February policy, and it was in line with market expectations. If you would recall, during the February policy, a large section of the bond market were expecting RBI to change stance or at least show concerns on liquidity, and they probably wanted a comfort on liquidity front. It was also in line with the global theme, as we saw during the beginning of the year. The bond market was expecting about 150 basis of rate cut from the Federal Reserve. So given that in February overall global conditions were quite benign, at that point of time the market was slightly disappointed with the RBA policy. But given moving on to April, as commodity prices have moved up, as growth indicators are looking better, as the expectations from the Federal Reserve also had come down, market was not really expecting any meaningful change in the policy. So in fact, the MPC composition also remained the same. They voted 5:1 to keep the policy rate unchanged at 6.5, as well as the stance was retained as withdrawal of accommodation. The FY25 growth outlook was retained at 7%, and the FY24 growth outlook was adjusted to 7.6%. That was the second advanced estimate given by the NSO. It's not really RBI's assessment, but NSO's assessment. I think the key takeaway from the RBI policy from the market was, one, on liquidity. RBI continued to reiterate that they will intervene in the liquidity market through VRR and VRRs to keep liquidity even, to keep overnight rates close to the policy rate, which is 6.5, which they have been doing for the last 3 months. So they continue to reiterate their commitment to reasonable liquidity. More importantly, on inflation and on future rate outlook, they retained their CPI inflation projection as same as 4.5%, although with a slightly downward bias. If you can see the table compared to February 2024 to April 2024, they have revised 1Q inflation projections from 5% to 4.9, Q2 from 4% to 3.8, and even the fourth quarter of FY25 from 4.7 to 4.5. So broadly, given that they are expecting slightly lower moderate core inflation, they do expect inflation to remain well behaved. What is concerning RBI is uncertainty on food inflation, given that we had a very weak monsoon last year, given that even the reservoir levels are running quite lower compared to last 10 years average, and even compared to the last year. RBI is rightfully concerned on any meaningful food price shock, and hence they want to be data dependent. They want to be confident that inflation is indeed getting close to their target before they think on stance or they think of any easing. As far as our view is concerned, our view has been that probably this cycle will be shallow. We are looking at 50 to 75 basis rate cut once RBI gets more confident on their inflation projection. That view still remains, that once probably the RBI sees through the monsoon and is more confident that there is no spillover impact of any food price shock to inflation and to inflation expectations, probably it will be in a better position to take a call on interest rates. In the next 3 to 4 months, we will also get a sense on how global inflation is coming along. And so both from a global as well as from a domestic perspective, RBI will get a better understanding of how they can go ahead with the monetary policy.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.